Before we get into financial gravity, you get into finance, you're working with financing companies. Do you want to walk people through? Obviously, the majority of people listening to this have never financed a company or know much about it. In theory, do you want to walk through kind of the steps? Does a company come to you? Do you find a company? Like, how was it working in the earlier days?
Well, I think there's a lot of every investor that wants to invest in a project has their own preferences as to how the deal's structured, whether it be debt, equity, convertible, warrants attached, whatever. They have their own idea as to how they want it structured, and they have certain things they like to invest in and others they don't. A lot of people will stay away from retail or restaurants or even energy or whatever. And so you've got certain people that like certain types of projects. And so the problem with raising capital as a private company out in the marketplace, the two biggest problems is you have a hard time bridging the gap in valuation. Obviously, a private company, an early stage or developing company, it's hard for them to have a big balance sheet or have a big value in the early days. And if they're going out and trying to raise $3 million or $5 million, then what's their company worth? And what does somebody get for that $3 million or $5 million? And so the problem is that in the company or the founders may think it's a golden opportunity, but the investor doesn't. And so they can't ever come to terms on the value as to what do I get for my money and how long. The exit is the other one, is how long am I going to be in and how do I get out? What does that look like? And if I invest $500,000 into a project and it doesn't get off the ground or get traction or get there, I might have to invest another $500,000 to keep from losing the first one, to keep it going. And so people are very concerned as what's the exit, whereas a public company, the exit's a given. You're going to have a liquidity event, you can sell your stock. And so the value and the exit's the problem, and the public transaction defeats both of those because you've got the liquidity event and you've got the valuation at a higher rate. The private, there's so many different ways, and so a lot of companies and a lot of people that have a project will one of the biggest problems is they have a business plan and they go out and they share it and they say, okay, we're trying to raise $5 million and it's quote negotiable, and it's like you're just not going to get there. You need to know where you're going and what you're offering and what you're giving up and what it looks like and what they get and how they fit in and what it's going to look like, how they're going to get diluted all the way through the process. And if that's understood, then it's a lot easier to raise capital with companies.
Yeah, interesting. No, I mean, information is important. Curious question, just to throw at you now, and maybe this will be a good little just segment that we clip out. But, when we're looking at, whether it's chat boards, we're looking at, other investment mediums, and people say, how do I spot a company with toxic financing, or how do I, identify toxic financing? Do you want to, kind of talk to people, obviously, what, maybe toxic financing is in some ways, but also maybe how you'd spot it?
Well, and there's a lot of different reasons that it's toxic, right? I mean, if you go do an equity line with an investment bank, they don't want you to have a lot of convertible debt that's convertible into equity because they could get positioned pretty heavy in your equity, and then and they start selling it and doing well, and all of these other debt holders convert. And now they've got millions and millions and millions of more shares into the marketplace immediately. And if they converted out of debt, then they probably counted that time they were dead against their 6-month hold. So now they can trade immediately, and then they flood the market. So that would be toxic in that case. Another thing that a lot of investors got to look for is when they look at a public company, they need to be careful that they're looking at a public company that doesn't necessarily have billions of shares of stock, and you'll never, there's always going to be millions and millions and millions out there trading and stuff, and that's great but it's probably going to trade at a lower rate because they've flooded the market with it. And then you've also got to watch out for people that have a public company that they've got a preferred stock that the founders or somebody controls that has like 1,001 voting rights. And so the structure of some of the public companies make it so that your sophisticated investors don't want to play. They look at what they think maybe games are that the company or its management have put into place to keep control. And if they're not open to people that have a better idea, then maybe they don't need our money. And so that can hurt a company when they do that to themselves.
And would you say that most of these toxic financings are, that people see in the markets are because, well, the company needed money and they had to pull the strings that they needed to do to get that money, and then that's the case they're in? Like, is it almost like making a deal with the devil, or do you think it's more of a game where the management team is behind it in some cases as well? What are you seeing? Just curious.
I think it's people. It's more the problem is people that don't know what they're doing and they're not getting good counsel. And as far as the public company is concerned, there are people out there that have been around the block that know all the ways that, or know a lot of the ways that they can take advantage of somebody, and they find companies that need capital badly for an acquisition or something, and they respond with a solution. But they structure it as such that if things don't go just exactly what they want, the lender's in control. And one of the ways to avoid that is like with an equity line. The problem is a lot of times with an equity line, you get to, you can draw down every week or every 10 days or something against that line. But then the investment bank or whatever, the investor, the funding source may go forward and say, okay, during the next week or the next 10 days, what's the low low sell of the stock? And that's what we're going to fund against. Well, what if somebody shorts the stock? What if you got a $3.80 stock and somebody shorts it down to a quarter? Well, you traded at a quarter, so now we get to fund you at that, or worse. And so what happens is they fund against those low sales, and then they build up tens of millions of shares, and that's painful.